Thank you, Keith. Thank you, Peter, for having me, and thanks everyone for coming along. There's quite a few familiar and indeed friendly faces in the audience, which is nice. I need a former co-author of mine actually on the wall as well, watching over me. So Keith mentioned this is the second, I think, of the alumni lectures. Last year was Jim, and Jim's an economist. This year is Andy, and Andy's an economist. So to sort of paraphrase Oscar Wilde, to choose one economist is misfortune. To choose two, Keith, is bordering on carelessness. I was seeking a theme that would join up my time at university, my time at Sheffield, and my current world. And actually, the link was easy to make, and the link is institutions. The last 30 years I have been institutionalised, deeply so, bookended by my time at Sheffield at one end and my time at the Bank of England at the other. Both great institutions. The university now over 100 years old. The bank a little bit older. That's why it's called the Old Lady. 320 years old a few months ago. So the link there is obvious, but actually when I thought about it, there is a deeper link, a common thread that links these two, which I want to discuss this evening. And the common thread is living standards. It's innovation. It's growth. It's society becoming progressively better, generation by generation. And that's the common thread I want to run through my lecture tonight. Hold on to it, because I'm going to wander around a bit. I don't want to stick rigidly to economics, that would bore many of you, but wander around and tell the growth story from a few different angles and hope that story glues together. To give you a flavour of that, these are some of the characters I'll try and weave in. We should probably name check them up front. I'm not looking for a name, by the way, for this. Any guesses? It gets Neanderthal man, just to set us off. And this one, anyone? Tefal, very good, Tefal man. Unknown to Generation Y, actually, Tefal man, but familiar, I hope. This one, a little bit harder. Deng Xiaoping, very good. I reckon this one's hardest of the lot. Anyone? It is very good. I thought that would be the hardest, actually. I wasn't sure anyone would get it, but here he is in his full glory. So I'm weaving these characters and one or two more besides and telling a story about growth and where it comes from and how to nurture it. Because that's as important an issue today as it ever has been. And institutions have as important a role in nurturing growth than they ever have in history. That'll be the theme of my talk tonight. So let's look at the growth picture. Let's look at the picture we typically look at as economists when studying growth. And here's one. It's a long run. It's of global GDP per head back from 1750 onwards. Log scale, so straightish line means steadyish growth rate, and the line is straightish. Growth has been pretty steady and upward over that 250-year plus period. It's averaged around 1.5% per annum on a per capita basis, which means, roughly speaking, that generation by generation, we're a third better off. Throughout this window, each generation has felt about a third better off than its predecessor. Economists often divvy up this window, this growth window, according to innovation phases. I've done that here. Typically 3 are identified, all familiar to you. First one, middle of the 18th century through to roughly middle of the 19th century, the Industrial Revolution. From the tail end of the 19th century through to the early part of the 20th, the era of mass industrialization. And then from just after the war, John von Neumann, Alan Turing, we've had the IT revolution, which of course is still with us, arguably still in its early throes. Growth pretty steady throughout that, picking up a bit towards the end. The normal story of steadily rising growth. Except, of course, looked at over a longer window, there's nothing normal at all about this picture. So let's widen the window and look instead over the last 2,000 years. The last 2,000 years. This now is GDP per capita growth over that window. The dotted line is where I started my previous chart. And you see in that almost 1750-year period prior to the Industrial Revolution, growth or significant growth was not the norm. Year by year, on a per capita basis, growth was what these days we would call anemic. About just over 0.01% year by year. Generation by generation, we would not have seen a material leap forward in living standards. A clear phase shift in the fortunes and welfare of society at large. So let's try to tell a story then about what made the difference. What was it that turned the key? What was the secret sauce that created rising living standards, the type of which we now take almost as read? Well, here's where the economics comes in. And I've got Alec Crystal. Where's Alec? Who was my professor? So this is wrong. It's Alec's fault because he taught me everything, right? So here's a secret. What do macroeconomists know? Well, I think at root, they really know only one thing. If an economist tells you they know two things, they're probably exaggerating by a factor of at least two. But the one thing is jolly important, and this is it. Today's investment is tomorrow's growth. So the key to growth is investment. But investment in what? Well, typically we tend to break down the accumulation of investment, capital if you like, three ways. And these are the three ways we break it down. Each individually is tremendously important. Some are typically focused on more by economists than others. The three are social capital. I've given some examples of what that includes. They'll all be familiar to you. Human capital, education, skills, experience. And finally, physical capital, buildings, machines, increasingly ideas or software. And looked at through this lens, it makes very clear why it is the university, why it is universities really are such a key driver of society, of the economy. Of course, they are, first and foremost, perhaps, machines for creating human capital, for educating us, and we've all benefited hugely from that. But of course, universities are also a great source of social capital. Tonight's event is an example of the social capital created by the university system. There's people here tonight who I knew from university. There's people here tonight who I've got to know through the university. That is a huge pool of social capital created by the university system. And the third source of capital, physical capital, we tend not to think of as being typically sourced from universities. What I want to argue is that that is increasingly not the case. That as well as offering human and social capital, universities increasingly have a place in generating fiscal capital. and therefore driving forward growth. So let's now use this three-way classification to make sense, try and make sense, of that phase shift in growth I mentioned, either side of the Industrial Revolution. Let's start with social capital, a tricky thing to measure, but here's some metrics that speak a bit to it. In some ways, they are the negative of social capital: wars and crime. Here's two pictures. This one goes back a long way. The chart is a bit fuzzy. It starts in 1300, right? And the measure here are murder rates in Western European regions. This chart is a different measure of social capital. This is wars since 1940. What are the key, these are both taken from Steven Pinker's work, the key theme of which is that secularly over time, there is a decreasing incidence of violence in society. These are among the pictures he uses to tell that story. That big fall-off in violent crime comes just after the Middle Ages, coincident with the Industrial Revolution, the pickup in growth. And the pattern that was true over long windows is true over the shorter window since the war, during which time the incidence of war has also been in decline. On the face of it, social capital, at least as measured here, is at least part of the story of the growth pickup. So too is human capital. Again, two metrics, this one over a very long window, this one again since the war. This looks at adult literacy rates, again back to 1475, the big pickup comes around here as we enter the 18th century, coincident with the Industrial Revolution and the accompanying pickup in growth. Here, shorter window, but a no less significant, dramatic pickup in higher educational attainment as a driver of growth. And finally, the third dimension, which is physical capital, plant, machinery, buildings. Again, one chart covering a long window back to 1850 in the UK. This is plotting capital, the capital stock per head against GDP per capita, a strong and strikingly upward trend link between them, more physical capital per head, greater output per head. This chart takes a bunch of countries over the period since 1980. It plots the same thing. It plots the capital stock per head against output per head. In each case, we see the same upwards sloping line. Of course, different countries are at different stages of development. The UK and the US up here, with high capital stock per capita and high GDP per capita. Down here, China, just beginning its ascent. Korea, following the footsteps of Korea earlier. But the pattern here in each case is pretty common. And the story is one of physical capital accumulation contributing to the growth dynamic. And just to bring that right up to date, let's just take a little example. This is where Deng Xiaoping comes in. So the architect of reform in China from the end of the 70s through until the early 1990s set China on its course to growth. Back in 1990, GDP at purchasing power parity exchange rates, not per capita, just total GDP, in China was roughly the same as GDP in Italy. What happened next? What happened next? Well, what happened next was that Italy invested not very much at all. It accumulated rather little fiscal capital over that period, to a first approximation, zero. Over the same period, China invested very significantly, at a rate of something like 20% year by year. You fast forward the small matter of 23 years, and the picture looks like this. China now has an economy that is 8 times the size of Italy. To use, I know Jim likes quoting these numbers. So China now creates a new economy the size of Italy every 18 months. It creates an economy the size of Portugal every 6 months, an economy the size of Greece every quarter, an economy the size of Cyprus each week. A few years of investment buy you quite a lot, and there is no better example in history than China's experience over the last 20 or 30 years. But that's not the end of the story. I've covered the last 2,000 years. Let me now take you back a little further and point to a second phase shift in growth that occurred at a much earlier date and trace its origins. So this is it. Unbelievably, and it is unbelievably, there is GDP data back to 1 million BC. Now I can tell you, back then, national statistical agencies were thin on the ground. And the data were even more unreliable than our current Office of National Statistics. Nonetheless, it tells a quite interesting story. I mean, this is speculative stuff now, but stick with it for a bit. I've talked about the phase transition pre- and post-industrial revolution. Let me now talk about the earlier one. The one that occurred either side of around 25,000 BC. Okay. Because prior to that, as best we can tell from these terrible data, nothing much happened. Nothing much happened. But after that point, growth picked up to this heady number, 0.0025% in the period that followed. Why? Why? What was going on? What were the deep origins of this phase shift in growth? Well, here's where my characters come back in. We have two men, Neanderthal and Tefal. They have some similarities. The most obvious of which is the haircut. But they also have a very clear difference. Would anyone like to venture a guess at the difference, the physiological difference in these two entities? Paul says forehead. Paul is right. Paul is right. The defining physiological difference between Neanderthal and man and Homo sapiens was that those prominent brow ridges were replaced by the straight, that's why I had picked Tefal man, the straight high forehead of the Homo sapien. And that was not done for no good reason. The good reason was to accommodate that part of the brain, which neurologists would call the prefrontal cortex. And we now know that among the things the prefrontal cortex does is patience. It does deferred gratification. It does waiting. It does, in short, investment. An investment, of course, whether it be in human, social, or physical, underpins my story of what drives growth. Is the story speculative? Of course it is. But is patience, is the capacity to defer gratification important in driving behaviors, in driving investment, in driving growth? I would say absolutely. Indeed, we have compelling evidence, experimental and psychological now, that speaks to just that. Some of it traces back to a study by a psychologist back in the 60s working with children. Who's come across the marshmallow test? Conducted with children to try and test out their capacity to defer gratification, in this case, sweets or marshmallows. It was a fascinating study. What was it that prompted some children to grab for the marshmallow and others not? What coping devices did children have that enabled them to stop reaching? But actually, what Walter Mischel found from this study ended up being much, much more interesting than he first thought. And the interesting thing came when he started tracking through how those children behave as they entered adulthood. And what he found was a very striking pattern, that the children that were able to defer gratification, that didn't reach for the marshmallow, consistently outperformed their greedy peers. They achieved higher levels of educational attainment. They were more likely to get a job. They earned, on average, higher incomes. They reported, on average, higher levels of life satisfaction. They were less prone to addictions or substance abuse of various types. The capacity to be patient was fundamental in shaping the life choices of these children. Behaviours honed in the nursery. And now we have a wealth of evidence that speaks just to that asks the question, how does patience affect our behaviours? And it turns out that patience affect our behaviours in very fundamental ways, in pretty much every aspect of our decision making. I've given some examples here, all of it based on experimental evidence. So patient people, as measured from things like a marshmallow test, are more likely to save. That's pretty obvious. They're more likely to stay on higher education, more likely to avoid those addictions I mentioned. They're more likely to vote, to join a gym, to stick rather than twist when they're investing, to save on energy. And crucial for my story, they're also more likely to be technically innovative, to put away for tomorrow, to take a chance, to invest today for payoffs tomorrow. Now, that naturally begs the question, if there are these deep neurological roots to our behaviours, the capacity to be patient, to defer gratification, how are they evolving over time? Well, on this there is a pretty active debate. Are we becoming more or less patient over time? Some factors would suggest that we're becoming more patient. The declining incidence of violence will be one example. But equally, there are factors that push in the opposite direction, that may lead us to become more short-termist, more myopic in our behaviours over time. And among the drivers of that potential drift towards greater myopia, information is one of the most important among them. Of all the revolutions that we've lived through over the last 50 years, the information revolution is for me among the most dramatic. Here's a fact, sort of a fact, about just how dramatic that revolution has been in information. So by 2020, it's guessed that the information created in those first 20 years of the century will account for more than 99% of all the information ever created. We are throwing off information at a rate never close to being replicated in human history. Is this not a good thing? Well, in many respects, of course, it is. But does more of something come sometimes with potential costs? And what might those costs be? Well, it turns out that some of those costs were pretty well articulated over 40 years ago by this guy, Herbert Simon, who I'm sure a number of you have come across. Hard to define what Simon was, certainly an economist, but actually a general clever clogs and polymath. Information theory was certainly one of his things. And even back then, here's what he said of an information-rich world, the type of world, of course, we're all now inhabiting. That wealth information means a dearth of something else, a scarcity of whatever it is that information consumes. Now, what information consumes is rather obvious. It consumes the attention of its recipients. Hence, a wealth information creates a poverty of attention and the need to allocate that attention efficiently among the overabundance of information sources. That was Herbert Simon 40 years ago, but the self-same thesis has been put forward more recently to make the case, to assert that similar dynamics might be at play today. Similar dynamics might, over time, be leading us to make decision-making, to make our decisions in a more myopic fashion than in the past. This book I mentioned here, Is Google Making Us Stupid? The thesis being that the plentiful availability, limitless supply of information is tending to make us more short-termist in our decision-making. Indeed, that neurologically, there might be evidence from MRI scans of that being the case. This feature called neuroplasticity, that our brains might rewire in response to information provision in the same way as is meant to be the case of previous revolutions, such as in the printing press and the typewriter. Who knows whether this hypothesis of progressively greater myopia in response to progressively greater information is true. But let me offer just one or two snippets that at least point in that direction. Herbert Simon, what information consumes is rather obvious. It consumes the attention of its recipients. Hence, a wealth of information creates a poverty of attention. Here's the incidence of attention deficit disorders over the last 40 years or so. This data is not uncontentious. And many of you are much more expert on it than me. But on the face of it, that line is going up. That's as good as it gets if you're an economist. Let me show you a line that's going down. And I couldn't hope to compete with Jim on the football front. But here's my mini attempt. This is the average tenure of football managers in the Premiership. I've drawn a line through it because that's what we do. What the line would suggest would be that the average tenure of a Premiership manager is declining roughly by 1 month per year, right? And by the end of the sample, we're at about a season and a half, which, if this trend were to continue, which it now won't as I mentioned it, would mean that by 2020, the average duration of the average Premiership manager would be less than 1 season. Would be less than 1 season. And if Arsene Wenger is sacked before the year end, that prediction may yet come true. Now, let me turn this to something more, even more important than football, which is the economy. Because we have an example from economics of just this self-same phenomenon. Oh, actually, I missed this. I have to discuss this because I mentioned Colonel Sanders earlier on. So, a few years ago, some psychologists did an experiment. They tested the patience of 2 sets of individuals. And then, for half of that sample, they flashed subliminally images of Colonel Sanders and the McDonald's arch. Subliminal meaning at such a speed that it couldn't possibly enter the conscience of those individuals. It could only enter subconsciously. Then they were retested. And those that had been shown these images had discount rates that were a third higher than those that hadn't. Fast food had made for fast thought, even though they'd only been given a subliminal nudge. The smallest of things, the smallest of cues, can make a huge difference to our capacity to defer gratification and be patient. So, why does this matter for the economy? Well, here's why. Back in the 19th century, two great innovations came forward, two great financial innovations in sowing the seeds for future innovation. And those two great things were a market for public equity and the public limited company. Those great innovations drove forward much of the innovation that we've seen subsequently. And equity, not debt, but equity, was a perfect instrument for financing that innovation. It was perfect because it was perpetual. Unlike debt, it was meant to last forever. What's more, because innovation is risky, equity does a much better job of sharing risk than does debt. No fixed coupons. You decide what you pay to your equity holder. So in principle, the invention of equity and the accompanying rise of the PLC was ideal, the ideal platform, fundamental, base rock for innovation, and so it proved through much of the last 150 years in the financing of railways and car manufacture and software. And so, is that still true today? Is that still true today? I'm going to argue that it is not. That in principle, this perfect instrument and perfect model for financing innovation has somehow gone wrong. Why do I say that? Well, equity is perpetual. It's for the long term, and yet the average share these days is held by the average investor for less than 6 months, and often a lot less than 6 months. The secular trend here is very clear and very downwards. 40 years ago, the average share was held by the average investor in the UK for 6 years. Fast forward, today it's below 6 months. Equity contributes nothing in net terms to financing companies in the UK. A shocking fact. Public listing of equities globally has been in secular and significant decline throughout this century. It's more than half the listing on global equity markets over the course just of this century. If you ask CEOs, they'll tell you this. Surveys of CEOs make clear that they will reject outright projects, long-term projects, that would create value for their firm because they feel short-term investors at the door, requiring them to reject just those projects. If you do some fancy stuff and try and work out how much of an excess discounting of longer-term returns is happening, my work suggests it can be very significant in a way that's likely to forestall and put off investment. In particular, R&D investment, where, as I'll show you from this picture, the UK fares pretty poorly. This chart, Keith gave me the perfect cue actually. This is sourced in Sperry data, which is an institute that Keith mentioned at the beginning, which is doing great work on this issue. It's an international league table, sort of R&D spend. This is the UK. We are faring pretty poorly, and this line has been trending downwards over time, not upwards over time. Now, this is only physical capital. It's not necessarily human capital, it isn't social capital. Nonetheless, it's telling a story of the possibility of investment being subpar. And today's investment is tomorrow's growth. That's the one thing I meant to know. Low investment today, weak growth tomorrow. Which is among the reasons why some people now are worrying. They're fretting about this thing that Paul and I were discussing just at the beginning, about the possibility of so-called secular stagnation, growth getting stuck at levels that are too low. Why might that be? Well, let's go back to our decomposition. It's about investing too little. It's about R&D being somehow subpar. There's no one piece of data that tells you this is a reality or even a significant risk. But here's a striking picture. This is a picture of how much it costs the government to borrow in inflation-adjusted terms in the UK at present. All those numbers are negative. All those numbers are negative. The government can borrow for 50 years and be paid for the privilege of so doing. People are sticking their money in safe stuff as an alternative to sticking their money into risky stuff, the type of which would finance future investment, the type of which would finance future growth. I couldn't end on that miserable note, could I? I ought not to end on that miserable, and I'm not going to, because redemption is at hand, and here's where it lies. In institutions. We now know, for a long time, economists ignored institutions. They viewed them as largely irrelevant. That was a huge, huge oversight. The fantastic work of Darren Atamoglu and James Robinson, which is a fantastic book called Why Nations Fail, published a year ago, perhaps 2 years, based on a detailed case study looking through a long history of many countries, established for me very clearly that the defining feature between those nations that succeed and those that fail are institutions. They are the glue that cause nations to stick together, and they are the driver of growth. And that makes perfect sense, because what institutions have that we as individuals perhaps have too little of is patience, is longevity, is the capacity to defer gratification until tomorrow, or indeed the year after, the day after tomorrow. They can also provide nudges to society to innovate in ways that they might not otherwise. Here's a little study, again a psychology one, similar in spirit to the KFC McDonald's one. This was another example, sample of people. Their creativity was tested, and then they were shown subliminal images of these two things, IBM and Apple. The Apple sample, after being shown these images, felt they were a lot more creative. The IBM sample did not. The smallest subliminal nudge was enough to change their frame of reference. And part of the role of institutions can be to do just that. I mean central banks, my current home. I mean universities. I mean development banks, state-backed banks that finance infrastructure, the sort of thing that Jim's been speaking about during the course of this year. We see it happening. We see it happening in partnerships between the public and private sector. There's this book called The Entrepreneurial State by this economist, Mariana Mazzucato, who was recently given a prize actually by Sperry in the New Statesman. The theme of which is that the best innovation often comes from these sharing relationships between the public and private sectors. Fantastic facts like, the iPhone, 94%, 95% of the innovation in an iPhone was backed ultimately by the state rather than the denizens of Silicon Valley. What's true between public and private sector is as true between universities and companies. That partnership is, for me, becoming ever more important. And Sheffield, our university, provides a fantastic example of just that. Because over the course of the last 10, 15, Keith, tell me, 20 years, the building out of the relationship between the university and companies has been a fantastic success story. And what is true in Sheffield is increasingly the case across other parts of the university network, including through these catapult centres that we see springing up. This, for me, offers real hope. If any of my story of dwindling patience, dwindling R&D, and dwindling growth has any force, then we need some bulwarks. And what better bulwarks then institutions such as our university network working in tandem with companies. I think my time is probably almost up. I think all of us here tonight would accept very readily that we have benefited, our human capital, our social capital, has benefited hugely from our Sheffield experience. The theme for me tonight has been that what is true of us individually is also true at a societal level as well. Institutions such as our university have never been more important than now for driving forward growth. Thank you for listening.